Well, welcome up everybody to the Middle Class Investor. Thank you for coming in. Today is Christmas Eve, 12/24, and before I begin, I want to wish everybody a Merry Christmas and a Happy New Year. Obviously, we're not getting a Santa Claus rally this year, but there are some interesting and important things happening in the market, and we will spend some time talking about them here. Just to recall, back when we were making these highs, I pointed out that, back when this started to roll over a little bit, that it was rolling over where the internal momentum was making a lower low. And we said that was a bearish divergence, and then that we should be on alert for that being a negative for our 401k balance and growth. And just want to point that out. Now you can see the market is very oversold. But the thing about these oversold, the thing about the MACD and all oscillators, RSI, is when you have a large degree move, they can be oversold or overbought for very long periods of time. They work really good in kind of the middle of the trend. They're middle of the trend type oscillators, and normally you'd probably use them on a daily chart or something like that. I mean, you wouldn't typically. I mean, you can use them on a weekly chart. You can use them on any chart, but there's two things. There's a couple other things I want to say about them. One is all oscillators like the MACD, the RSI, and any stochastic or anything like that. They're all developed on price. So some derivative of price, or the sum of the squares of price, or something like that. So at the end of the day, your attention should be on price. So I just want to point that out. A lot of times people think, they find an indicator that works, a couple of times, and then they think, oh my gosh, they found the holy grail, and you'll hear them go on and on and on about the MACD or the RSI or some other stochastic or some oscillator. And that's usually an indication to me that they really don't know what they're doing. They think they know what they're doing. They think they've stumbled upon something. They figured something out that absolutely nobody else was able to figure out. And therein lies part of the problem in the market, is people in general don't understand that markets are probabilistic in nature. There's probabilities. If you recall, maybe back in here somewhere, right as we were making these highs, as we were coming to the top of this channel, we were looking at kind of this information right here. And we were talking about what is the probability of the market going, 2, 3, 4% higher from here, given all this, given this run up. Because this started at the bottom of the channel, and we were getting close to the top of the channel. And I suggested that, probabilistic speaking, it's probably good to start taking some off here, and maybe be on a little bit more on the cautious side. Instead of saying this is the beginning of a new bull market, recognize that the market's moved quite a bit, and maybe this is a good place to start taking some off. And of course, hindsight's 20/20, but we did speak about that. Of course, the market pulled back pretty hard and then proceeded to make new highs. So it was surprising at the time, but then we saw this bearish divergence. And there again, when you're looking at this, the same question applies. Given that we've had what looks like a wave 4 pullback, and we run up quite a bit, and now we're approaching the middle of the channel, or whoops, hold on a second, and we've got this bearish divergence developing. Maybe we should take some off the table. And of course that proved to be the right thing to do at the time, because we're far below that now. Now we're 400 points below, almost 650 points below that number, and we continue to fall. Today we're down. Of course, the market's open. Well, it just closed actually, but the market was open until 1 p.m. Eastern today, and it closed down. The S&P closed down 65.37 points, and so the market continues to sell off. Now we are, if you notice this gray line here, this is the 200-week moving average. Now the 200-week moving average usually is not looked at very often, but the 200-day moving average is, and you can see we are. Where's the 200-day? It's right here. It's right on this line, and it follows right here. So the 200-day moving average is way back at 2750, and we're at 2350. So we're 400 points below the 200-day moving average, which that's pretty significant. But if you notice, the 200-day moving average has barely started to fall. So I think what we'll see is we'll probably see some more selling. You'll see this 200-day moving average start to fall. Maybe fall into this area somewhere in here, 2550 or so. And then about that time you'll see a big rally into that 200-day moving average. And if you haven't sold, that's a good place to sell. Now, we've talked a lot about the psychology of the market and how difficult it is to sell or buy at the right time. And of course, that's why you want to have a decision that gets you out somewhere up in here. You break the channel, you're out. Maybe you're out right here, or maybe you wait for a little bit of bounce and get out here. There's all kinds of techniques you can do, but whatever it is you come up with, you want to stick to it. So if you saw the break of the channel and then the retest, and you got out here, let's say just above 2800, and the market came down and it went above 2800. I mean, you don't want to be kicking yourself going, man, I shouldn't have got out. You want to kind of just wait and see what happens. And as you can see, it sold off again, rallied again. I'm seeing this is the way the market tops. It tends to you tend to get kind of the market doesn't just sell off straight. You tend to get this kind of rounded, kind of fall like this. And that's what we have here. So, all right. But anyway, a pretty big day, sell-off day in the S&P 500. The market actually, I think it gapped down. Yeah, it gapped down a little bit this morning, ran up, and then quickly sold off. And the bears have been in control for quite a while now. So if you go back to a weekly chart, you can see that last week was significantly down. This is a significant down week. It kind of matches this one up here. And probably once this one gets going, it's probably going to even be bigger than this one. So, the bears are in control of the market right now, but isn't it interesting? I mean, just looking at this 30-day average here, or 30-week average, the market broke through it, retested the 30-week average, broke down through it, retested the 30-week average. I mean, this 30-week average, is pretty important. If you kind of back up, well, I've got a lot of stuff on here, but you can see this 30-week average is right here. I'll see if I can kind of draw it freehand here. It's this line right here, so it kind of follows along like this and this, but you can see we're above it a lot of the time. And that wave 4, we broke down below it, but then came back above it and then broke it right here. So, of course, we were below it here, but the difference is we came into major support. So a break of the 30-week major average where you find support, and maybe right here, you buy, you get in. So just keep that in mind. That 30-week moving average is a pretty important moving average. And people, traders and investors do look at moving averages, so you need to know that. All right, let's turn off quick toggle, or let's turn off the studies. So hide studies, and then let's move on to some of our other charts. Well, let's look at the VIX. Where's the VIX? I always have a hard time finding the VIX. There it is, VIX. Volatility is clearly up. It's now above all this from way back. There's a kind of a spot here. It's now above all this area here. This is the meat of the VIX right in here. Got below the meat here a little bit, then rallied up, then kind of came back and tested the low end of that range, and now we're above that range. And so you can see it you can kind of see that it's, it's kind of getting like this. So, I'd say we'll have probably a little bit more, maybe this week and maybe next week, a little bit more volatility. We could spike up above. I would say we're going to make new highs, so we're going to have to get above, this 52 area, probably before volatility comes in significantly. So that just means more selling, and so be on the lookout for that. Now the 10-year Treasury, we've talked about the 10-year Treasury. We've had this support area on here for some time, and it looks like we're going to at least pull back into this yellow zone, this decision point area, and which makes a lot of sense, because if you look at this, well, you can't see here's kind of the wave 1, 2, 3, here's a 4, here's another 4. So this zone right here, this DP, is support off of these wave 4s. And so it's not uncommon for the market to pull back to the previous wave 4 low before it takes off. Now let's contrast that with the S&P 500. Here's the previous 4th wave low. So the DP off of this low would have been somewhere, here, let's just draw it. It would have been about, maybe right here. And we've broken that zone significantly and are moving down in a hurry. So what happens? What's probable after this? After you get a 4th wave break, a break in the 4th wave low, which we clearly have here at this point. What's the probability? What's the probability of the next thing happening? Well, what tends to happen is the whole 5 waves gets retraced. So what is that? That's this area down here. If I can grab it or something, let's see, move. Let me put it in the right spot. Really, I guess where this blue area is about the right spot. But this zone here is a retrace of the entire move. So this is the entire move. 1, 2, 3, 4, 5. So you get a break of this 4th wave low, which would have been right here around 2,500, which we clearly got. The probability is that the market goes all the way back here to the previous 4th wave low, or the beginning of this pattern. Now, will that be the end of the bear market? I mean, we don't know. We don't know for sure. What I think is more likely to happen, and let me maybe look at a month. Well, no, that's not going to work. Let's look at let's just get more data on the chart here. What I think is more likely to happen is that this will just be the first leg in the bear market. So the first leg of the bear market will come down to here somewhere, and then we'll get some sort of A, B, C rally back up into this 2,500 area, and then we'll have 5 waves down lower. And how low, nobody knows really, but it could be substantial. So we want to make sure that we're, not. Sorry, I got something going on. There we go. So I think the probability is that we come all the way down. We end up retracing the whole move from the top and at least go back to below the 2009 low. Now, some of you are going to go, I don't know, that seems impossible. I mean, what about all the productivity that happened here? What about all the good that was happening here? Well, if you really look at it, I mean, what really happened here is the Fed's balance sheet went from about 200 million to about 5 trillion between 2009 and now. And so what's going to have to happen is this balance sheet's going to have to be worked off. And so all this was just QE. A lot of it was just QE. Some of it was real wealth being created. There were businesses created. There were productivity gains in various industries. But the lion's share of what was created between 2009 and now was just paper wealth. It was just asset inflation through QE. And this is the problem with asset inflation, is it kind of benefits the financial markets and assets in general, but it doesn't necessarily benefit real business. In fact, most of your real businesses during this time, just muddled through. I mean, they weren't really prosperous. They weren't really, setting the world on fire. They were just kind of getting it done. And the reason they were only getting it done is because a lot of the gains were going into the financial markets, and they weren't going back into capital investment and real investment in businesses that improves productivity and creates wealth. Now, how do we know that? How do we know that real investment wasn't being put into our markets? When I say real investment, I'm talking about in plant and equipment. Well, we know because wages over almost this whole time were stagnant. Why were they stagnant? Well, because there was no capital investment. Capital, essentially what it does is it helps workers be more productive. When you work in a factory, or even if you work in an office and your employer buys, a new business system, or if you work in a factory and your employer buys a new machine, let's say, just as a simple scenario, let's say that you had a job punching holes. This is ridiculous, but it's a ridiculous example, but the example holds. Say your job was to work in a factory and punch holes, and maybe with some of the manual tools that you use, maybe you could punch 500 holes in a day in some sheet metal or something that you're supposed to do. Well, somewhere along in here, your employer buys a press, like say a multi-stage press or something, and not only does it punch the holes, but it forms the metal and prepares it for the next operation. So let's say it's welding or something. So now instead of punching 500 holes a day, maybe you're able to punch 5,000 holes a day and prepare it for the next operation. Well, that's an increase in productivity. You as a worker are now more productive than you were before. And so what happens is the actual cost of the produced goods that your company makes goes down, and you sell more, but wages typically go up in this process as well. And so none of that happened here between 2009 and now. And so basically all this is going to get erased. And the truth is none of that's been happening since probably 2000. So not only are we going to erase all of 2009, but we're going to substantially go back in time. Let's put up all. We're going to substantially go back in time to probably somewhere around this area. I've got this area as a minimum. So let's just say as a minimum, we're likely to go back to around 200 on the S&P. Now that is a long way to go. But given the financial engineering and the economy and the government's involvement and the manipulation of interest rates and all this stuff that the Fed does and that our government promotes, and the spending, you got to remember too, government's gotten bigger, much bigger over this time. I want to say back here in 1987, the size of government was only about $1.2 trillion, or maybe $1 trillion. Now it's $4 trillion. And not only that, but our debt here was maybe $1 trillion or $2 trillion, and now it's $22 trillion. So you have all this extra debt. You have a lack of business investment, a lack of productivity gains, and you basically just have market manipulation that has led to asset price inflation. That's essentially what we've got. So, as they say in economics, there are no free lunches, and because there are no free lunches, all this will get erased, most likely. At least down into this area, at least down below 500. So, clearly, if you've saved a lot of money, you have a 401k or an IRA, you don't want to experience all that. So, you need some sort of methodology for taking yourself out of the market. And that's what this YouTube channel is all about. That's why I make these videos. That's why I ask you to share them with your friends and family. So now some people will say, oh, that'll never happen. Well, the reality is a lot of people aren't students of the market. And so in order for them to believe that's going to have to happen, in order for them to believe that that'll happen, they're going to have to experience it firsthand. The problem, obviously, with experiencing it firsthand is that you can't recover from it. So you either have to be a student of the market yourself and go study it and understand what causes it to go up, what causes it to go down, or you need to find somebody that you trust that can help you, stay out of these problem areas, which we've got a big problem area on the horizon. So I feel like I've been, preaching a little bit. So I'm going to get off that. So let's go to the 13-week Treasury. Let's put it on the non-log scale. And let's go back to a 5-year chart. And of course, the Fed recently raised rates. We talked about that last week, that they were going to raise rates. And now we're starting to see, maybe a pullback in the short-term interest rate. Maybe. And what I'll do is I'll wait for a few more cards to come out of this deck, see if we make a higher high or a lower high. Maybe we pull back a little bit and then we make a lower high. Well, then we'll draw a new trend line under here and see if the rate of change is starting to slow. My guess is this is more of just a pause. There's, markets do that from time to time. You can kind of see it here. Market traded up pretty strong all the way through here. Well, let's even go back to here. The market traded sideways, broke out, and then what did it do? It traded sideways again, and then broke out, and then drifted up, traded sideways right in here a little bit. Kind of see a little sideways pattern here, and then broke out, and then traded sideways here, and then broke out, and then pulled back. I mean, this is very, very common. The market doesn't just go straight up. This is almost trading sideways here. Broke out. It's been trending a little bit sideways here. So when it gets ahead of itself, it either trades sideways or pulls back. Mostly we've just been trading sideways with a little bit of pullback, not much. And so likely we're going to have, some sort of sideways movement, maybe a slight pullback to just below this low, and then probably a new breakout. But the rate of change may be slowing, like at least temporarily. Like it was pretty steep here, and then we had a new rate of change, and who knows, we may get a slower rate of change, or we may get a steepening. Could get a steepening. But clearly interest rates are up. The Fed will be raising. We've talked about why is the Fed raising. The Fed's getting a lot of criticism right now from market pundits talking about, the market's selling off. Why doesn't the Fed respond by not raising rates again? The Fed is trying to maintain its credibility. The market, this right here, the 13-week Treasury or the 3-month Treasury yield, this is the market. This is not the Fed. So the market, as the market moves up, the Fed it can only move the interest rate up. It has to in order to maintain its credibility. If this rate just went up and up and up and the Fed held rates low, then people would wonder, well, why are the rates going up? The Fed's not raising rates. And they would start to see then that the Fed doesn't actually control rates. The Fed really doesn't even set rates, the rate that they set. It's a suggestion to member banks. That's all it is. Member banks can still either not lend or lend at higher rates, and they don't have to lend at the Fed rate. They typically do, especially when market's quiet. But when there's upheavals in the market, they don't do what the Fed says. They do what is in their best interest. So just know that, and I've said it before, but the Fed does not set rates, it follows rates. So as long as this is going up, the Fed will be raising rates. And of course, they're going to get a ton of criticism because the markets are going to be selling off and people are not going to understand why the Fed is still raising rates. All right, let's look at the 10-year. I think we already looked at the 10-year, but let's look at it again. I would say we're at least going to go back into this area around 2.6, which is not far from where we are. So it might be a week or two longer before we hit that. So look for that, and that would be an area where the market might turn, bounce, and start going the other way. All right, let's look at these other countries. Let's look at Germany. Germany's clearly is topped, at least for the primary degree trend. Japan is topped for the primary degree trend. And the UK has well, hold on. The UK is topped for the primary degree trend. So all these markets now are moving in unison. That was not clear immediately. I mean, it wasn't clear if they were going to move in unison or if Europe was going to lead the US and vice versa. So, but I think it's clear now. Let's look over at gold. So here's gold. This is the big run up, big bull run up. And this has all been sell off. Gold is finally broken out. Looks like it's going to go from here. And I would say, you know, if you're in gold and you're trading it to the upside, I'm not in gold because it just still seems really choppy to me. But I would look for gold to go into this area here. And that's a pretty good move, you know, from 1270 to 1470, 1450, something like that. So remember, as the dollar goes up, you know, well, the dollar is going to be rising here a little bit, but gold could go up for a while before the dollar really gets going. But once the dollar gets going to the upside, we're probably going to see this trend continue down in here to below, I don't know, below 900, below 800, somewhere around in there. So if you're wanting to buy physical gold, you know, you can wait. We've talked about some of the risk of waiting. You know, the government may put controls on it. The commissions may be so high that you feel like it's not worth it. You may not be able to get any gold. I mean, I don't know. We're going to be in somewhat uncharted territory, so I'm not sure what to expect. Silver is also moving out, although much more timidly. In fact, you can't even hardly see it without zooming in, but you can see here it looks like it's starting to move out. I suspect when it gets above 14.95, it'll probably start moving a little quicker. The euro US dollar, we just spoke about the dollar a little bit. Oops. The euro, you know, it kind of, I don't know, it looks like, you know, it wants to, I don't know, it's kind of looks like it doesn't want to do anything. It's it's been going down, but we haven't gotten much of a retrace yet to trade back in this direction, and we don't have a lot of price, you know, there's not really a kind of a clear bottom here either. So I'm kind of sitting on my hands with gold. It could be, if you zoom in, it could be a triangle going on here. And of course, when it comes out of the triangle one way or the other, that may indicate the direction of the euro. The US dollar, again, it looks different, right? It's looking like it's taking out here. This whole breakout here above this last high for the euro, where this would be a low, this didn't happen in the euro. So there's a little bit of you know, non-correlation going on with the euro US dollar, and that could be because of other markets or something like that. Oil, I mean, oil's just getting crushed. It's likely to get down into this area, either this decision point area that I've got marked here. You can see this yellow bar that I've got marked here, or it could just make its way all the way down into this trend line and then bounce from there. So I wouldn't be investing in oil stocks or anything right now. I'd be sitting on my hands waiting for this to chop around a little bit more, maybe start making higher highs and higher lows. We've talked about a really long-term forecast of oil. Again, you got to remember, oil's also, it's sold everywhere in the world in dollars. So the price of oil is not just a function of the supply and demand, but it's also a function of the price of the dollar. So as the dollar really starts to take out and rally, you can see oil really fall in this later stages here, a couple, 3 years from now. That's really about it. I want to show you the Dinarics charting. This chart is a here. Let's show you the longer term chart first. Here's the weekly chart, and You can clearly see, all the degrees of trend. He's got all these different colors just represent a different degree of trend. The primary degree of trend is in red. So you can see we've made 5 waves, not only in the primary degree. I'm sorry, the primary degree is in black. No, that's the cycle degree. Primary degree is in red. So we've made, intermediate, primary, and cycle degree 5s. So that just means that, like I said, the first move, we're probably coming all the way down into this area. This is the Wilshire, so it's got a slightly different price scale. But we're likely to come all the way down here to this 18,000 area on the Wilshire. If you look at he's also got a 2-hour here. So he's showing, this is from what was this, intermediate degree wave 2. And you can see, if you really wanted to, you can count the waves here and the ABC up for this degree, whatever that degree is, minor degree. Or maybe this is minute and this is minor. So this is a minor degree 2, minute degree 2, and of course now we're in some sort of 3. So we're in, technically we're in a third of a third type of situation. So you should see selling pick up even more than today as people begin to really panic in the market. So this is a 60-minute chart. You can see here clearly, here's wave 2 of minute degree, and we're in wave 3. Of course, we even went lower today. So this is last week's chart. So anyway, that's that. Again, the reason I use this Elliott wave is you can still see it's very choppy, and of course in real time it's very difficult to use this to trade, but it does give you a context for where we are in the market, where we are in the trend, how long the current trend might last, things like that. So that's why I use it. Again, trading on it on a daily basis, using it is very difficult and tricky. There are ways to do it, but it doesn't involve counting waves. It has to do with some other stuff, some port that I use. And if you're interested, you can go look at YouTube on MT Predictor, Steve Griffiths. I think he uses Elliott wave in a way that's productive and profitable. I think counting these waves and trying to do this is really very, very difficult. But if you can find somebody that does a good job, like Deneric's Elliott waves, he does a really good job, and he can really help you, again, try to understand where you are in the trend and how long it might last and how far it might go and so on and so forth. All right, everybody, that is it for this week's Middle Class Investor. Thanks for coming in. And again, Merry Christmas and have a Happy New Year. We'll be here next week and do it all over again. Thanks for coming in. Bye-bye, all.